You don't want to be in that situation where they're asking you why you did what you did and they're questioning you directly. When I say they, I mean the IRS. Hey guys, Toby Mathis here, and today we're going to go over advanced tax strategies for real estate investors. And I'm going to really focus on 4. So I'll call it 4 advanced tax strategy for real estate investors and make it even more concise and easy to follow. So let's dive right on in. Now, before I start down the list of the 4, what I am going to say is about tax professionals, people that you work with. Here's what I would do. I would find somebody who does what you do. If you run a small business, make sure you have an accountant that has run a small business. If you're doing real estate investing, make sure you have an accountant or whoever you're going to use as your professional who has owned and operated investment property before, because there's too many nuances that exist in those niches that you're not going to get out of a book and that they don't get taught in school. So it's no offense to other folks out there that are CPAs or EAs or accountants, but you really got to find people that do, or at least work for an organization that does exactly what you're doing. So for example, when I teach, it's out of the experience of, we have over 300 properties with my partner, and this is what we've been doing for decades. I understand the nuances of it because I do my taxes, and this is how we end up. Like, these are the same strategies that we use. This is the strategies that tens of thousands of real estate investors use. And so everything is tried and true. There's no question about it. You do want to make sure that you have a professional signing your return. I don't want you doing your own return. I know you might be able to do it, but by all means, you want to be able to point the finger at somebody else. If you ever find yourself in an audit, just to make life easier for yourself, you always want to have a professional sign off. Even if you're doing a lot of it as a self-prepare, it'll be really easy for your professional, and there's just no way to put a value on being able to say, oh, they did it. And then please communicate through them instead of to me. You don't want to be in that situation where they're asking you why you did what you did and they're questioning you directly. When I say they, I mean the IRS. You don't want to be in that situation of going through that audit. So this is always, hey, how do we minimize the risk to ourselves? How do we take targets off our back? How do we get out of things quickly and cheaply if we ever find ourselves in an audit, lawsuit, etc.? We just want to make sure that we're minimizing the impact of those things on our life. And so talk about minimizing, one of the big impacts on our life is taxes. And these are some advanced strategies to reduce those taxes. So let's dive on in. Number 1, a 1031 exchange. Everybody else is lost out except real estate investors on 1031 exchanges. They've been reduced, eliminated for everybody else but us. And here's the scoop on 1031 exchanges. They are absolutely fantastic for about 4 different reasons. Number 1 is the tax deferral on them is fantastic, right? I can buy property for 100 grand. I can allow it to mature. I can put improvements into it, and then I can take that property and diversify it into other properties by selling it and rolling the gain. And this is important, the recapture of the depreciation into another property. There's different ways to do this. I'm not going to go into all the different ways, but a starker exchange is the most common one. I sell a property, and within 45 days I identify replacement properties, and within 180 days of the sale of the closing of the first property, I close on the other property or properties. You can diversify into multiple properties if you want in different type of real estate. So that's number 2. Number 1 is tax deferral. Number 2 is diversification, because I can take, hey, let's say I was in single family properties and they've gone up in value, and I say, you know what, I'd like to get into some land, some self-storage. Maybe I'd like to do some mobile home parks. I can do that. I don't have to buy the same exact type of real estate. I can diversify into other real estate. So there's tax deferral, there's portfolio diversification, and then there's wealth accumulation is number 3. Wealth accumulation is pretty obvious. If I'm not being taxed on something and I'm not being subject to recapture, it allows my portfolio, my real estate investments to compound. And there cannot be an understatement on how powerful compounding is. So even if real estate's going up on average, let's say between 4 and 7%, and yes, I'm aware that it was going up like 20% a year for a while. What it allows us to do is diversify it into multiple properties, or to consolidate it if you want to go the other route. Let's say that I have 20 or 30 single family residences, and we say, you know what, I really just want to get them all into one fill in the blank, an apartment complex or self-storage or a commercial office place, like the strip mall down that's in my town that I know is always full and always is doing great. Maybe I'm doing that. Not my cup of tea, but maybe that's what you're doing. You can go either direction, but it allows us to continue to compound that wealth without paying a tax. And then this is really, really, really important, and people do not get this last point often, the estate planning of this. Here's what happens when you pass away. So I 1031, so let's say I take a $100,000 property, I fix it up over the years, it goes up 10 years later, it's worth $500,000, and I buy 4 other properties. So I trade the one in for 4, those 4 are all at $125,000, same scenario, they all go up over the next 10 years. Let's say they're worth $400,000 or $500,000 a piece, and then I pass away. Guess what? There's 0 tax to my heirs. I stepped up in basis when I passed away. Now let's go and say, instead of doing that, I gifted it. Let's say I had 4 kids and I gave each property, which is now worth, let's just say they're each worth $500,000. So we'll do simple math. We have a $2 million estate, and I gift it before I pass away to each child. Each child has a basis, which was my basis, and that goes all the way back to the first property I bought. The first property I purchased was $100,000. So my basis in each property is like 25 grand. Maybe there's some improvements and things like that, but my basis is really, really small. Plus they have recapture on all the depreciation I've taken over the years. So if they sell those properties at $500,000, it's almost all capital gains and recapture. It's going to be taxable to them. If instead I pass away and then they inherit, guess what their tax bill is? 0. That's why 1031 exchanges are so powerful when used appropriately. You could literally go from, hey, I invested originally $100,000, now over the years it becomes worth $2 million. And it's been paying me all this time, all these rents. That $2 million is tax-free. If my kids end up or my estate ends up liquidating those properties, they pay no tax. That to me is a fantastic benefit. So that's the 1031 exchange. That's why real estate folk use them. Yes, you could do reverse exchanges. There's ways to go buy property and then sell properties to get into it and things like that. Topic for another day. Just know that number 1 is a 1031 exchange. Number 2, let's talk about using self-directed IRAs and 401ks. This is what's kind of fun when you get into it. Number 1, in an IRA, a lot of people think all I can do is buy stock. Hey, I have my account over at TD Ameritrade or Fidelity or whatever, fill in the blank, Schwab now, by the way, for TD, right? And all I can do is buy stocks and bonds, right? No, that is not true. That is what their IRA allows you to buy. You are not prohibited from buying real estate, for example, or alternative assets in an IRA. You certainly can do it, but you need to make sure that your custodian allows it, and that's what a self-directed IRA is there's a custodian that says you can invest in anything that's legal, including real estate. So I could go ahead and I could buy real estate inside of my IRA. Now, some of you guys might be saying, hey, why would I do that? Why would I want to buy real estate inside of an IRA? Don't I get a lot of tax benefits individually? Yes, you do. But inside of an IRA, unless you're using leverage, there is no tax. Inside of an IRA, you could sit there and grow tax-free without having to worry about 1031 exchanges, without having to worry about anything else. You just get to immediately never pay tax on it. And if I'm making contributions to that IRA, I can be writing it off, right? Or if I roll a 401k from a previous employer into my self-directed IRA, I could go buy a bunch of rental properties and diversify myself from just having everything in the stock market, which is unfortunately what most IRAs do, is they're just in the stock market. And then you have somebody who's 100% exposed to that roller coaster ride. And I'm not saying anything bad against investing in the stock market. I am just saying that generally speaking, when you're investing through like your employer plan, you have very few options. And quite often, if there's a big change in the market, you're riding that coaster. And you might say, I am cool having a third of my assets in the in the stock market, but I would really love to have a third of my assets also in real estate, possibly more. And now you can do it. You can diversify. Maybe I want 50-50 mix. This allows you to do it with a self-directed IRA. Now, I will say IRA or 401k. So remember I mentioned that you don't pay tax unless you're using leverage. That is in a IRA. In a 401k, you do not have something called unrelated debt financed income, UDFI. What you can do is actually lever inside a 401k and pay no extra tax. Just having that little nuance. So you can get a higher return on your investment, and you are even in greater control when you're using a solo 401k. When you have your own 401k, you don't even need a custodian. You could be your own trustee. So I could literally put offers on properties. I could close without a custodian. But either case, IRA or 401k, you get a lot of benefits. There's big tax advantages. Let's say that I'm just looking at investing through a 401k, and I'm like, how do I get enough money in there? Let's say that you have your own business. Let's say you're doing a side business, and you're able to put in, it just depends on what your age is, maybe you're putting in up to, you're putting $50,000, $60,000 a year in there, depending on what the limits are for that particular year. Where I'm standing here now, I could defer $22,500 immediately of any pay that I would have received directly into there, into that account. If I'm 50 or over, I get makeup provisions. I can add another $7,500, so up to $30,000 tax deductible right into my 401k, which could then be investing, coupling it up with my other IRAs, roll it into that 401k, and boom, I have a nice nest egg that I could start investing in real estate. Or maybe my business is also making a 25% contribution, depending on what it's paying me. Let's say it pays me 100 grand a year. Maybe I have a side business, my own business, whatever it might be, but I'm putting an extra $25,000 in there as well. That is also tax deductible, plus my 30. Now I'm getting some horsepower. Now I'm over 50 grand a year. Yes, you could do that. Even if you have another 401k with another employer, you can do that. The only rules you got to be aware of when you're doing 401ks is if you have employees, you got to be careful not to violate any discrimination rules with them. But again, you're able to put a bunch of money in a tax-deferred vehicle, sometimes all-out tax-free, whether you're doing a Roth 401k or a Roth IRA. You may never have to worry about tax ever again, but the idea is that you're putting it into real estate, and you're able to do so because it's a self-directed IRA, a self-directed 401k, or a solo 401k, or self-directed Roth IRA, self-directed traditional IRA, or solo 401k. And all of those, you have control over the assets. You get a bunch of tax benefits, you can diversify, and you can invest in real estate as opposed to just being stuck with the stock market. The third advanced tax strategy that I want to go over is cost segregation. Cost segregation is one of my favorite things because it's the way we should be accounting for our real estate, period. Full stop. The IRS allows you to use 27.5 year or 39 years on real estate to deduct it. You're taking a deduction. It's called depreciation, but you're depreciating the improvement on land. So I buy a piece of property and it has a box on it that is a rental property. The IRS says if it's residential, you could write it off over 27.5 years. If it's non-residential, like commercial, it's 39 years. And you take 27.5. There's a convention for like half monthly and half yearly and all these different, like when you actually put it into service comes into play in that first year. But just for ease of use, just think you're taking 1/27.5 or 1/39. That's inappropriate. That's not an appropriate methodology. In fact, if you take a cost segregation, you put it into play, you're going to be filing a form that's called a 3115 that literally says you're changing from a method you're not supposed to use to the method you're supposed to be using. And that's because when you depreciate property, which means I'm taking a deduction against my income, every year, in this case, if it's rental income, it's passive income, so you have a passive deduction, or you have a deduction that's going to go against that passive income. So I have rents. Let's say I have $10,000 of rents coming in and I have $10,000 of depreciation. That means I pay zero in tax. So I have zero net income because I get to write off that depreciation, right? What we're doing is we're saying, hey, I take that land, I take that improvement, and I'm breaking it into components. I'm changing it from just being 27 and a half years, but I'm actually going through and saying things like the carpeting, for example. The carpet is not 27 and a half year property. To the IRS, that is 5-year property. If I have land improvements, like I put a deck on the property, I put a fence up, I put in a bunch of trees, I put in a driveway, the IRS says, oh, that's 15-year property. If I put in cabinets, if I put in appliances, those things might be 5 or 7-year property. The IRS says that's its useful life. That's what you should be depreciating. You should not be depreciating it over a longer period, 27 and a half years. And then see if this makes sense. Let's say that I buy a rental property and I depreciate the carpeting over 27 and a half years. When I sell it, the IRS says you have to recapture all that deduction and I have to pay tax on it. So I'm paying tax on carpeting that is 27 and a half years old, right? Let's say that I bought a property and I sold it after 10 years. That's a better example, right? I have to pay tax on the depreciation I took on that property, on the cabinets, on the land improvements, on the driveway, on the stinking carpeting. I have to pay tax on that, even though we all know it's not worth a cent because it's so nasty. What cost segregation allows us to do is avoid the recapture on that property because its useful life is all used up, and that saves you money as well. We've actually done cost segregations, believe it or not. You could do a cost segregation on property that you sold last year but you haven't filed your taxes on this year. So we've actually done cost segregations on properties that were already sold. As long as you can get access to that property, you could go in there and do your cost seg and figure out what property I should not be paying recapture on so that you can lower your tax bill. I'll just think of one example, was a warehouse property that was sold. It reduced the taxes on the property from about $280 down to closer to $200 on the sale of that property. There's about $800,000 a gain, if I'm not mistaken, when I'm looking at that scenario. And it lowered and saved in pocket tax savings, $78,000 done after the sale, going back. Can you cost seg property that you bought in previous years? Yes, it is an extremely powerful tool. Even like, let's say you bought one in 2020 and it's years later and you say, can I cost seg it? Yes, you may have to do a change of accounting. It's called a 3115, but you could do that all the way up until the year after the property that you're cost segging. You could do it for a tax year the following year. So if I have, let's say it's 2023 that I'm doing a cost seg for, I can do that cost seg for the year 2023 and affect my 2023 taxes all the way up until I file a tax return in 2024. And by the way, it's including extensions. So we're talking October 15th for an individual. We're talking September 15th if it's a partnership, right? I can make that election to cost seg that property and get that extra tax benefit, accelerate that depreciation, and get that deduction now versus waiting it out. Why do you do this? Because it's like putting extra money in your pocket. Sometimes we create extra loss because we depreciate it, and it's going to offset other passive income that you have, unless you qualify as a real estate professional or an active participant in real estate, in which case you can write it off immediately, or you're not in a rental activity. For example, believe it or not, Airbnb, if your average daily use is 7 days or less, it is considered a trade or business, and so long as you are materially participating in that business, you can take that loss from the cost seg on that property and use it to offset your W-2 income. Or let's say that you have another business, you have 1099 income, offset any other income you have. Otherwise, it's just considered passive loss, and it's going to offset your other passive income. So at a minimum, what these cost segs tend to do is eliminate any taxes you pay on the rents that you're generating off a property, generally speaking for 8 to 10 years. You get tax-free income for 8 to 10 years when you're doing a cost seg. That's about average. Because a typical cost seg, you're getting about an extra 30% deduction in that first year. I'm running off about a third of that property in the first year that I elect to do the cost seg. Now, hopefully, you're listening to this and you're buying properties this year and you say, you know what, I'm going to cost seg that property. Get an analysis done and see what the benefit to you is going to be. A lot of times you see folks that have other rental properties, they have lots of rental income coming in and they're paying tax on it and they're paying it at their highest bracket. It's ordinary income. And they have another job and they have all this, all this income coming in. I always think of the doctors when I think of these folks. And they have, it's just adding a whole bunch of taxable income into a really high bracket. And they're like, boy, this stinks. We can eliminate that by doing a cost segregation and at least making sure that that extra rental income is not taxed. Now, number 4, our last one, advanced tax strategies, is using entity structuring. A lot of people miss the boat on this one because number 1, there's an absolute benefit for asset protection from using an entity structure, but there's also a tax benefit to using an appropriate structure. A lot of times people don't realize that when they put a asset protection plan together using LLCs in usually it's land trusts, LLCs, Wyoming statutory trusts and the like, but they could also have a corporation managing it. And what that allows us to do is pull money that would have flowed onto our return into another realm. And let's say it's a C Corp, that tax bracket might be 21%. And as long as it's a reasonable amount that's getting paid over to that corporation, I can dump money into it that takes it off of my tax return. And maybe that business is doing other things. Maybe that corporation has 2 or 3 other businesses, and I'm taking the money that would have been taxable to me, putting it into a realm that becomes a deduction. And it's able to allow that business to continue to grow and compound in a tax advantage method. The other reason entity structuring works so well in real estate, it's because you could scale. You can scale using syndications. You can scale using partnerships. In other words, it's not just me, but maybe it's 2 or 3 other people, and we go in on properties together, and it allows us to scale up. Or you go out and you do an actual syndication. You see these all the time. Hey, we're going to buy an apartment complex. Hey, we're buying self-storage. Hey, we're buying a mobile home park. Hey, we're buying 20 rentals. And instead of just one person buying each property, they all get together, form an entity, and they buy 20 properties. That's what you use the entity structuring for when you're doing real estate. And then you cost seg them and make sure nobody's paying any tax on any of that income for a long period of time. And then the last one is estate planning. Estate planning absolutely is important. When you put pieces of property into entities, I don't care whether it's a land trust, LLC, or Wyoming statutory trust, you're removing it from that individual piece of property being probated in that particular state. If I own properties in my name in multiple states and I pass away, I am probating in each one of those states. If I own it through a entity structure, it's just where I passed away. And if you use a living trust like we advocate here at Anderson, we do not want you passing away and going through probate. We want to avoid probate. The way you do it is through entity structuring. That's going to save you a ton of money from the state. It's going to save you a lot of time for your heirs, so now they're not having to go through a 12 to 18 month process to get access to property or to transfer property. It's automatic, boom, it's already in nice containers, and it passes right through without having to get a court order because it's held inside of an entity structure. The last one I'll hit on, and this kind of blends in, is when we are looking at different types of real estate. So for example, if I am trying to qualify as a real estate professional and I need to have enough rental properties so that I meet the material participation test, but I have Airbnb properties, which by definition are not rental properties, right? If it's an Airbnb and it's 7 days or less, it's a trader business. I can convert that through an entity structure into rental income. How do I do it? I take my hosting and I make it into a corporation and I rent the property from myself long. So I might rent my rental properties that were used for Airbnb on an annual basis to a corporation that then does the Airbnb activity. Why do I do that? Because now I am still an investor and I can couple it with all my other rental real estate and qualify as a real estate professional. Whereas if I did not do that structure, I would be not able to use the time I spent on the Airbnbs towards meeting my real estate professional status. If you understand how real estate professional, I've done other videos on them. There's multiple tests. There's material participation, but there's also the 750-hour, 50% of your time test. But the material participation test is only on your rental activities. And if you are doing Airbnbs, there's a good side to this. Hey, if I don't want to meet the real estate professional status and I just want to treat it as a business and I self-manage those properties, for example, I could just immediately do something like a cost seg and offset a bunch of my W-2 income. But if that's not me, but I have other properties and I meet the material participation test on rental property, then I want to make sure that I do not disqualify myself because I can't use the time that I spent on my Airbnbs towards the material participation hours. I could set up a situation where I rent it to the corporation and the corporation is the host. That's the active business. Me, I'm just an investor, and now I get a big tax benefit. So the top 4 tax benefits that we just hit, the 1031 exchange, using self-directed IRAs and 401ks, cost segregation, and number 4, entity structuring, those are all advanced tax strategies for real estate investors just like you that you can use to minimize your taxes, to isolate your assets and get asset protection, and they go very, very well with an estate plan as well.